Hey, what's going on, guys? Welcome back to my channel. This is Blood Fantasy Media Win. In this video, I'm going to be talking about a comment made by my new buddy Dave over at Hidden Freedom Investing. On my last video, he basically said, still more sell-off to come in REITs, I think. And so today I'm going to address what my thoughts are on that. I agreed with him, unfortunately, and the reason why I say unfortunately is because I have a lot of money in REITs right now. I just recently started opening up some positions, so today I'm going to talk about what I think about the REIT market in general, and we're going to learn some new things about how to think about sectors and industries, so I think it's going to be a really cool video. So to start off today, I'm going to talk about some of the hypotheses that I have about REITs in general. And I think whenever we think about some kind of investment, whether it's a stock or an ETF, we always have some kind of hypothesis in the back of our minds that decides, whether or not it's going to be a good investment. So we do these things automatically. And so today we're going to talk about some of the hypotheses that I have going into REITs. So on the screen here, I have some of the largest ETFs. They're sorted by total assets. So basically, the higher the ETF is on the list, then the more total assets that ETF has under it or flowing into it. This next column is year-to-date performance, and for our intents and purposes, we can say that REITs, for the most part, hovered around the 20% mark year-to-date, which is pretty good. So at the top of the list, we have VNQ, which is Vanguard's real estate index fund, total assets of $35 million. Next on the list, we have Schwab's US REIT ETF, which is totaling $5 million in assets. And third on the list, we have iShares US Real Estate ETF, which is at $4.4 million. So why are we even looking at these ETFs? Well, I think if we can assume that a lot of investing is passive and a lot of investing is through index funds or ETFs, I think we can also make the assumption that a lot of that money is going to go into some of these larger ETFs. And given that, we can also take a look at some of the stocks within these ETFs and think about some buying opportunities or just observe their behaviors a little closer. So the first ETF on the list is Vanguard's Real Estate Index Fund, and it is by far the largest ETF. It's over 6 times the previous largest ETF. And so we're going to take a look at that one first. So these are the holdings of VNQ. It's not all the holdings, but we can see some of the top holdings. At the top of the list, we have American Tower Corp, ticker symbol AMT. Next, we have Prologis Inc., which is ticker symbol PLD. Next, we have Crown Castle International Corp., which is ticker symbol CCI. Equinix, ticker symbol EQIX. Simon Property Group, ticker symbol SPG. Public Storage, Welltower, Equity Residential, etc., etc. We even see our favorite stock here, which is Realty Income Corp., so on and so forth. So the first hypothesis I have is that REITs are good long-term investments regardless of market conditions. And so the article I'm looking at is REIT.com, which is comparing average REIT returns and stocks over long periods. Starts off by saying you probably already know that the total returns of exchange-traded U.S. equity REITs have generally outpaced those of other U.S. stocks over long investment periods. For example, in the longest period measured by the Russell 3000 index of the broad U.S. stock market from December 31st, 1978 through March 31st, 2016, total returns for exchange-traded U.S. equity REITs have averaged 12.87% per year compared to just 11.64% per year for stocks. And so that's over a 1% difference between these REIT ETFs and stocks, which over the long haul, over an average annualized difference, is actually a really big difference. However, I like that they're honest enough to include this disclaimer, which is investors need to know whether that long-term outperformance by REITs is the normal state of affairs or whether it could only be the result of a last-minute run-up in REIT stock values. Actually, there hasn't been any recent run-up in REITs except during March 2016, plus 10% for REITs, plus 7% for stocks. And this next part is where it gets interesting. In fact, during the past 3 years, March 31st, 2013 to March 31st, 2016, the Russell 3000 has actually outpaced the equity REIT market with total returns averaging 11.15% compared with 9.85% for REITs. So this is just an example of past performance not equaling future performance. So in the long run, it doesn't mean that REITs are always going to outperform some of the broader equities. But the other thing is I also don't like comparing any kind of asset class to the Russell 3000. I think the Russell 3000 is going to have, a lot of run-ups. Obviously, it's small caps, so there's lots of potential for growth. But I think for the most part, Russell 3000 tends to underperform a lot of the other major indices, and so I think I'm going to ignore this part right here. But the main gist we should not ignore, which is REITs can in fact underperform some kind of index fund at any given point in time. However, for the past 30 years, that hasn't been the case. So that's basically the main point I want to make here. The other thing I want to show is this chart right here, which I think is pretty awesome. It's the average annualized total returns over rolling 10-year periods. So in the green, we have REITs, and in the gray, we have the broad stock market, which is the Russell 3000 index. So again, not the best barometer, in my opinion, for understanding the overall stock market, but still we can see side-by-side performance. And so this brings me to hypothesis number 2, which is that the reason why REITs outperform stocks is because they tend to be more defensive than stocks. And sometimes the best offense is a good defense, and I think that's exactly true for stocks. However, I would much rather prefer something like REITs over something like bonds. Even though I think bonds are even more defensive, I think they're a little bit too defensive for my taste. So let's go ahead and dissect what this chart means. So basically, each of these periods represents 1 year between 1988 and 2015. And each data point is the average annualized return over the past 10 years. So it's a rolling window. You'll notice that the worst rolling window for REITs, which is in the green, was never even below 3%, whereas the Russell 3000 could have been negative, and in fact was negative for more than just 1 year, or more than one rolling period. For this entire period right here, between 2008 to 2010, which is obviously the last stock market recession, the overall stock market, which is the Russell 3000 index, actually suffered quite a bit. And this brings me back to my original point of looking at these REIT ETFs. So I personally don't invest in REIT ETFs. I like to find deals within the entire sector. And so we are going to take a look at some individual stocks towards the later part of this video and think about which stocks are good buys. But one thing I want to address is we have to also look at performance, let's say over the past year, and think about whether or not REITs show defensive qualities or not. And the way to do that is to compare performance of certain sectors, in this case REITs, to the overall stock market and see what happens when the overall stock market went up or went down. One thing we can, for the most part agree on is technology, for example, is heavily correlated with the stock market. So whenever the entire stock market goes up, we can expect tech to also go up, but go up even more than the overall stock market did. But the same thing can be said when the overall stock market goes down. Tech not only goes down, but may even go down more than the overall stock market because it is a lot more volatile than the regular stock market. What kind of qualities do REITs have? Well, as a case study, let's go ahead and look at Realty income first. And before we do that, I think it's important to take a look at the overall stock market first, just to sort of memorize this chart a little bit. So we can clearly see there are some periods of lots of expansion for the overall stock market, and there are some periods where the overall stock market has some trouble. This is the S&P 500. We know that between October all the way to December of 2018, that was pretty much a really nasty period for the overall stock market. We know the same thing can be said about the start of 2018 as well. However, we know that between 2019, the start of 2019, all the way to where it is right now, for the most part, there's been a lot of expansion with clearly a few speed bumps along the way between April all the way to August of 2019. But for the most part, these are the trends. Now, what does Realty income look like? Well, Realty income looks quite a bit different. One thing we can say is that there isn't a lot of correlation between Realty income and the overall stock market, at least not as much as other stocks or other ETFs. However, what can we say about those really defining periods between the overall stock market? So this right here is October 2018 all the way to December 2018. This is when the stock market had a lot of trouble, but Realty income grew a lot. It actually grew by a total of 19%, which is exactly what the stock market lost during that same time period. Now, we also know that the overall stock market didn't do too well at the start of 2018. It is reflected here in REITs as well. However, as soon as that initial drop happened, and the overall stock market had choppy waters between February and March, REITs actually increased by a total of about 18%. Once again, during this time period where the stock market did okay, but there was a lot more choppy waters, REITs actually did pretty well. Next, I want to take a look at this period right here. So obviously, Realty Income went through a lot of trouble between 2016 to 2018. Now, one thing is true. We know that the overall stock market suffered between 2015 to 2016. However, towards Q4 of 2016 is when the stock market really started picking up again, with a few sort of bumpy rides along the way. But for the most part, all of 2017 was an expansion period for the overall stock market. How did REITs perform throughout that same time period? REITs actually decreased by 21%. And I know I said REITs, what I really mean is Realty Income, but we can see this with other REITs as well. But so this video doesn't get too long, I'm going to keep it about Realty Income. So there you have it. There's a few examples of REITs showing opposite performance to the overall stock market during different points in time. Now let's take a look at what's happening right now. So between November, or towards the end of October, all the way to now, Realty Income has dropped about 10%. No surprise, because the overall stock market has been doing pretty well during this time period as well. One thing I want to make clear with Realty Income and just REITs in general, though, is that there isn't a perfect negative correlation. We just start to see these things happening in trends. And the other thing I want to make clear is that Realty Income and other REITs also can also do really well, even when the stock market is doing really well. So it's not like they're always going opposite with each other. And it's not even like that correlation is perfect, but we can still see it in spades. And what I'm going to look at next is a few other examples of REITs that are getting hit pretty hard, that are showing the same sort of patterns that Realty Income is. The next one I can talk about is Welltower. Pretty similar chart to Realty Income, actually. Between October all the way to now, we're seeing this sort of drop right here. And the really characteristic thing about this drop is not even like a straight drop. What we have is a really heavy drop, followed by a sideways consolidation, some kind of bear flag, followed by another drop. The same thing can be said about Realty Income, which I just showed. Heavy drop, sideways consolidation, heavy drop. The same thing can be said about long-term care, or ticker symbol LTC, heavy drop, bear flag consolidation, another heavy drop. The same thing can be said about Ventas, ticker symbol VTR. Between October all the way to now, there's obviously a heavy drop, and there was some kind of consolidation right here. But this one's actually dropped a little bit worse than the other ones. The same thing can be said about Public Storage, ticker symbol PSA, heavy drop. This is a sector-wide outflow in REITs, in my personal opinion, all the way from September/October all the way to now. So if you are thinking about getting into REITs in the long term, I think now is a potentially good opportunity. Again, that's not investment advice. I'm definitely scooping up some shares right now of some of my favorite REITs. All the REITs that I talked about are all in the top 10 or 15 of weighting of VNQ. So you better believe that these stocks are heavily correlated with the overall real estate market. And so this would be a list that I would take a look at if I was thinking about buying more REITs. And this is an example of some of my position sizings in REITs. So on Realty Income, I currently have 4.7 thousand. My average return right now is -3%. Average cost at $74.93. But I'm actually picking up more shares as I go. And at most, I would have about $10,000 into ticker symbol O, or Realty Income. I think it might get to 6,000 between now and next week. And the other stock I'm buying a lot of is LTC Properties, ticker symbol LTC. I currently have 8.3K in it, down about 3.69%. Average cost at $45.97. So I currently have about 190 shares. This position will also increase to close to $10,000 between now and the next month, I believe. So now let's do another case study, this time from a technical perspective, of Realty Income. And so this is a weekly time frame, so each of these candlesticks represents a week. And what we're looking at here is Realty Income ever since the 2009 bottom. So we can clearly see that Realty Income has stayed above the 200-week moving average throughout this entire time period. The only time it was actually below it was for a few months here, towards the beginning of 2018. And so I'm not sure if Realty Income will end up retesting this area. I think that would be one heck of a buying opportunity, but I'll be sure to load up there. And I plan on adding about $1,000 into ticker symbol O for every couple of dollars that it drops in share price. There is the bear case, however, which is, what if the next recession is right around the corner? In which case, you're investing into something that might just keep going down even further. To that, I say I don't think REITs are going to do as poorly as the rest of the stock market, and they are sort of the best of both worlds in terms of being really defensive. And I want to wrap up this video by taking a deeper dive of Realty income. This is the closest thing that Blood Phantom 81 is ever going to do to fundamental analysis. But here we're looking at the top 20 tenants, and you can see the percentage of Realty income's revenue due to these tenants.